Good day to you all. Today, we are going to start a new lesson on business accounting. These are the main topics we are going to discuss under the subject. Before we move into the subject of business accounting, we must know what a business is and its outlook. This is one of the general definitions for a business. In this essence, it is clear that all our needs and wants will be satisfied by various types of business organizations. I assume that you have learnt about business organizations in detail under business studies and recall the business categorizations we discussed based on few principles. However, in accounting, purpose is considered as the primary objective to categorize business organizations. In this section, let's learn how we could further distinguish business organizations according to their purpose of the business. As a rule of thumb, business groups can be categorized under two segments as profit-oriented and non-profit-oriented business organizations. At the end of this lesson, you will learn to prepare financial accounts for each and every organization mentioned herein. These are some general activities and attributes of a business. Among all these attributes, primarily what we really see is that all these businesses involve in various transactions and events. In addition, there are stakeholders who are interested in the business and pursue all financial information of business to make decisions such as investing, lending, and many more. We call an exchange of assets that takes place between two parties and which could measure in monetary terms as a transaction. Transactions are the basis for all types of accounting practices. On the other hand, an event is a change taken place in business without any parties concerned but which can value in monetary terms. Generally, information is very important and plays a vital role for stakeholders who make decisions with regard to the business internally and externally. We can show elements of information system in simple like a flow. So, the parties who make decisions use different information to make their best decision regarding the business. Among all these information types we discussed above, financial information is the most vital information considered to make decisions. Now, let's discuss what actually takes place or required from financial accountancy of an organization or a firm. In earlier chapters, we discussed the importance of financial information to take decisions in an organization. Hence, financial accountancy provides key and vital financial information to take decisions in a business organization by its stakeholders. Financial accountancy contains number of processes in the organization, similar to other systems which we find in our day-to-day life. Financial accounting system provides the rules and structure for the financial information about businesses based on the current information and process according to certain accepted formulas and accounting standards. Some of the key information used in financial accountancy is illustrated in the screen now. Now, we will discuss the individuals and groups that use financial accountancy information to take decisions relating to an organization. There are two types of information seekers in a business organization. They are internal users and external users. Financial accounting provides the required information or insights to take appropriate decisions for the internal and external stakeholders. Financial information should be presented with 4 basic principles so that the users can have a reasonable understanding on economic activities of an organization which are listed in the screen. Financial information is very important to all stakeholders in different ways. Let's discuss how important this financial information to internal and external parties to take their decisions. Click on each of these parties appeared on screen to see why they require financial information. To provide financial information to internal and external parties, we learned previously there has to be an accounting cycle to follow. Let's discuss the phases of the accounting cycle. By clicking on each of these buttons, you can learn about every phase of the process. Let's discuss categorization of accounting transactions. In that sense, transactions are to be categorized according to accounting elements. Therefore, it is crucial to identify elements of accounting. The whole picture of accounting is based on so-called elements. These are the accounting elements which we are going to discuss. Now, we will discuss each of these elements. You can learn about these fundamentals by clicking each of these buttons. As you all know, as a result of transactions and movements, accounting element takes place. To develop relationship between each element, we use accounting equation. This accounting equation shows the relationship between how an accounting entity is being funded and how entity is being invested appropriately. It is a standard that all the time funded amount of an entity equals to all investment means they made. Accordingly, this equation is considered as the foundation of accounting equation. Also, profits will increase the equity as losses make decrease in equity. Now, you could understand that this equation can further be elaborated as shown on the screen. This is the profit or loss equation. Here, we calculate initial capital by deducting initial liabilities from initial assets. On the other hand, closed capital is the difference between closed assets and closed liabilities. There are few facts that cause changing of business equity and net assets, which we have already discussed in previous lessons. There are the sources for the change in equity and net assets. These details clearly show that additional capital provided and net profit gained during the accounting period increases the equity, and goods and cash withdrawals by the owners and loss made during the accounting period result in decrease in equity of the business. This is the most important principle of accounting. The basic principle of double entry bookkeeping is that there are always two entries, and one entry is known as credit and the other entry is debit entry. The impact on accounting basic elements as a result of transactions take place can be provided by an equation. However, in accounting, increase or decrease of these elements must be recorded in a ledger account according to the double entry concept. This grid illustrates the method of showing the impact on elements due to a transaction or an event using debit and credit entries. Since this is one of the important principles in accounting, you all should memorize this grid. If you really observe the impact on accounting equation due to transactions and events occur, it is clear that every transaction and movement has an effect on two places in the accounting equation. This is the dual effect of a transaction or movement. This double entry system was introduced by Fra Luca Bartolomeo di Pacioli, an Italian mathematician, and he is referred to as the father of accounting and bookkeeping. Double entry of a transaction or a movement is termed as debit and credit. Based on this double entry concept, all transactions and events that occur needs to be recorded in accounts. These are the steps to follow at the time of preparing accounts according to the double entry system. Firstly, it is necessary to distinguish what is an account, a debit, a credit, and layout of an account before we record double entries of transactions. Click on each of these buttons to learn more. Before recording a transaction in ledger accounts according to the double entry system, such transactions are recorded in journal books. These books are also called basic books, daily books, and journals. Generally, in a business, there are separate journals to record different types of transactions and events occurred. Normally, a business maintains approximately 7 journal books. It is costly and rework for a business to record transactions and events occur in journal without directly making notes in ledger books. These are the reasons for a business to bear such a cost and rework on records. Hence, it is important to maintain a set of journals in a business. Next, we will discuss the methods used to record these transactions in the ledger. Transactions recorded in this journal are the goods purchases with the purpose of resale. Purchase journal records only the credit purchases from suppliers and the source documents are purchase invoices. To complete the double entry, purchase account debits by the total amount of purchase journal and creditors account by net amount of invoice value. Transactions recorded in this journal are credit sale of goods purchased with the purpose of resale. Sales journal records only credit sales to debtors and source documents are sales invoice. To complete the double entry, debtor account debits by the net amount of invoices and sales account credits by total amount of sales journal. Transactions recorded in this journal are return of goods purchased with the purpose of resale. The source documents are debit notes. Debit note is a document prepared to inform supplier the return of goods partly or fully and the amount being debited to creditors account. By debiting creditors and crediting sales return account, the double entry is completed. Transactions recorded in this journal are return inward of goods purchased on credit with the purpose of resale. The source documents are credit notes. Credit note is the document prepared to inform debtor the return inward of goods partly or fully and the amount being credited to debtor's account. By debiting return inward account and crediting debtor's account, the double entry is completed. Cash book is the initial book a business uses to record cash transactions. However, cash transactions includes transactions performed by checks also. Cash book is different from other journal books as the cash book serve a dual purpose as a journal book and as a ledger book. Accordingly, cash book must be included in ledger account. However, the volume of daily cash transactions are high and cash account become larger in volume and capacity, and ledger also becomes larger in volume and capacity. Hence, businesses maintain cash books separately. There are three types of cash books: simple cash book, two-column cash book, and three-column cash book. Discounts are recorded in the third column of the three-column cash book. These cash discounts are offered to customers as an incentive for timely payment of their liabilities in respect of credit purchasers. This is the amount that a recipient forgoes from the total amount. This discount is the discount received for the party to pay cash and discount paid for the party received cash. There are important facts you all must know when copying cash book transactions to the ledger. In a business, majority of transactions are based on cash and cash payments are more complex. The reason behind that is, irrespective of the amount paid, it needs to get recorded accurately. In such instances, the duty of chief cashier is more complex and the preparation of cash book is further complex in nature. To avoid this situation, petty cashier is involved in addition to the chief cashier. Hence, he could completely focus on petty cash payments in the business. Petty cash transactions are not certain and it totally depends on the capacity and type of the business. Generally, daily and frequent cash payments with small amounts are considered under this cash book. Petty cashier is not empowered to collect cash or receive cash. Instead, his or her powers are limited to payments in small values. By differentiating petty cash from main cash book, complexity of chief cashier and main cash book is eliminated. Petty cash payments are recorded in petty cash book. This book is considered as a journal book as well as a ledger book. Hence, petty cash book also serves a dual purpose. Source document for petty cash book is petty cash voucher. It is a system of petty cash book where a person is given a fixed amount in the beginning of the period. The petty cashier submits the account of expenses keeping surplus amount himself. The chief cashier gives to the petty cashier another sum of reimbursement of the fund which equals the amount spent during the period. This process is called impressed system of petty cash book. This agreed certain period is called impressed period and certain amount provided is called impressed amount. This period and the amount differ from business to business. At the end of the time period, chief cashier provides the same amount spent during the period to petty cashier and fulfill the agreed impressed amount. This process is called petty cash replenishment. These are the advantages of petty cash system. These are the important things you must know when copying petty cash transaction to the ledger. Except for transactions recorded in previously mentioned cash books and other journals, a business has several types of transactions. All the accounting transactions are recorded in general journal in a sequential order before transactions are recorded in a specific journal. This journal is maintained essentially on the double entry system. Other names used for general journal are journal book and book of original entry. There are 6 types of records entered into a general journal. At the starting of a business, there are various types of assets, liabilities and equity to record in books. Before they are recorded in relevant accounts, they need to be recorded in the journal first. In addition, it is required to maintain a journal to record balances of assets, liabilities and equity at the end of financial period before those are entered into new set of accounts. At the start of a business or at the beginning of a new set of books, records that are entered in general journal are called initial records. Most of the time, value of capital or net assets can be calculated by using initial records. At a given date, net assets of a business are the difference between assets and liabilities. A business purchases assets such as lands, buildings, vehicles and equipment to use for business purposes. Also, a business could sell fixed assets. Such credit sales and credit purchases are entered into a general journal before recording in relevant accounts. Mistakes or errors can occur when making records on initial books and ledger. Subsequent to identification of such mistakes, those could be rectified by making records on general journal. Generally, there are instances where at the end of a financial period, some transaction may not be recorded in ledger accounts and entered transactions may not have considered the financial period and the consistency. Hence, the initial records relevant to a particular financial period are recorded in general journal. Accordingly, double entry could rectify errors in any account being an adjustment entry. Records that included in general journal to transfer of value from one account to another are called transfer entries. A business prepares profit and loss account to find profit or loss gain during a financial period. Therefore, balances lying on income and expense accounts during financial period must transfer to profit and loss account. Such records are entered into general journal until the records are transferred to profit and loss account. These entries are called closing entries. With that, the first lesson of business accounting comes to an end. Until we meet again with another lesson, have a good day.